The gap between knowing what to do with your money and actually doing it, that gap has a name. It's called behavioral finance. She knows all of it and she's still not doing it. I'm not a mindset coach. I'm not a therapist. I am a financial planner. And as a financial planner, it is my job to understand not just the numbers, but the financial behaviors that determine whether those numbers actually move in the right direction. That's what today's episode is about, the specific financial behavior patterns I see in my practice, where they come from, and most importantly, what it actually looks like to change them. Because I've watched women change them. I've sat across the table from women who went from paralyzed to invested, from avoidant to in control, from giving everything away to building real wealth for themselves. It happened because they understood what was driving their behavior. And then they took different action. Let's get into it. I see 4 behavior patterns come up over and over again. And I want to walk you through them because I guarantee you're going to recognize yourself in at least one. The first one I call the protector. The protector accumulates cash. She saves aggressively. She's cautious. She avoids risk, even calculated. Well-researched risks that would serve her long-term plan. On paper, she looks responsible, but what's actually happening is that her money isn't working for her. It's just sitting there. I had a client, let's call her Megan, who came to me with over 500,000 in savings account, earning less than 0.5%. She understood compound interest. She understood that inflation was eating into her purchasing power every single year. She could explain all of it back to me. But every time we talked about deploying that money into a diversified investment strategy, she couldn't pull the trigger. She felt physically uncomfortable. Now, here's what I want you to understand. Megan isn't irrational. Her brain learned at some point in her life that financial security means having cash you can see and touch. That was useful information at one point, but it was costing her hundreds of thousands of dollars in potential growth. That's a financial behavior with a measurable cost. The second pattern is the avoider. The avoider doesn't engage with her finances. She's not opening the statement. She hasn't logged into her retirement account in months. She knows there are things she should be doing and she puts them off, not because she's lazy, but because the whole thing feels overwhelming. So she does nothing. The third pattern is what I call the regulator. The regulator uses spending as an emotional tool. Bad day, she buys something. Big win, she buys something. Stressed, she buys something. The spending isn't about the stuff, it's about the feeling. The fourth pattern, and this one is one I see most in women, and it's the one that concerns me the most as a planner, is the sacrificer. The sacrificer consistently puts everyone else's financial needs ahead of her own. She's paying for her adult children's expenses while her own retirement is underfunded. She's covering more than her share of household costs while her partner builds an investment portfolio. She gives generously to family, to friends, to causes, while telling herself she doesn't need much. I need to be very direct about this one. The sacrificer pattern is not generosity. It's not selflessness. It's a financial behavior that has real consequences. I have sat with women in their 50s, 60s who gave and gave and gave, and now they didn't have enough to retire. They are dependent on the very people they spent decades supporting. That is not the outcome anybody wanted. Now, here's what I want you to take from all of this. None of these patterns mean something is wrong with you. They're all strategies your brain developed based on real experiences. The protector learned that money can disappear. The avoider learned that money is complicated or scary. The regulator learned that spending provides relief. The sacrificer learned that her value comes from what she gives to the others. These strategies made sense at one point, but they may not make sense anymore. And the data backs this up. Research shows that women who actively address their financial behavior patterns are 53% more likely to invest regularly. That's not a small number. That's the difference between building wealth and watching from the sidelines. So the question isn't what's wrong with me. The question is this behavior still serving my financial plan? All right, so we've named the patterns. We've talked about where they come from. Now let's talk about what actually moves the needle because that's what matters. I'm going to give you 5 things that I've seen work in my practice. 5 actions that actually move the needle. Number 1, get honest about what your current behavior is costing you. This is the most important one. And it's where I start with every client. We run the numbers. If you've been sitting on cash instead of investing, I can show you exactly what that has cost you over the last 5 years, 10 years, 20 years. If you've been avoiding your retirement account, we look at where you actually are versus where you need to be. If you've been overgiving to your adult children, we calculate what that's done to your own retirement timeline. This isn't about guilt, it's about information. You cannot make good financial decision if you don't have accurate data about where you stand. Most people don't want to look. I'm telling you, look. Because the cost of not looking is almost always higher than whatever number is on that page. Number two, connect every financial action to your plan. One of the biggest reasons women stay stuck in unproductive financial behavior is that they are making decisions in a vacuum. They're thinking about individual purchases, individual savings, contributions, individual investments without connecting any of it to a larger plan. When you have a financial plan, a real one, with a number attached to your work optional life, every decision has context. Should I invest this money becomes, does investing this money move me closer to my number or not? Should I pay for my adult child's rent becomes, what does this to my retirement timeline? It changes the conversation entirely. Decisions get easier when they're measured against something specific. Number three, automate the behavior you want. Here's what I know after years of doing this work. Willpower is not a financial strategy. If you're relying on yourself to remember to invest, to save, to contribute to your retirement account, you're making it harder than it needs to be. The most effective thing I do for many of my clients is help them set up systems that remove the decision point entirely. Automatic contributions, automatic transfers, automatic rebalancing. The behavior happens whether you feel like it or not. That's by design. This is especially important for avoiders and protectors. If your pattern is to disengage or to hoard cash, automation takes you out of the equation. The money moves, your plan progresses, you don't have to white knuckle your way through it. Number four, have the conversations you've been avoiding. I can't tell you how many financial plans are being quietly undermined by conversation that hasn't happened. The conversation with your partner about how expenses are split. The conversation with your adult children about financial boundaries. These conversations are uncomfortable. I get it. But here's what I tell my clients. The discomfort of a 30-minute conversation is nothing compared to the cost of avoiding it for another 5 years. And number five, get professional support. I'm biased, obviously, but I'm also right. Working with a family financial planner, someone who is legally required to act in your best interest and who doesn't earn commissions on what they sell you, is one of the highest impact decisions you can make. And I just don't mean for the investment strategy or the tax planning, although that matters enormously. I mean, because a good planner sees your blind spots. A good planner will notice when you're making a decision out of fear instead of a strategy. A good planner will hold up a mirror and say, you're doing that thing again. Let's talk about it. Remember what we covered last episode about family advisors. This is part of their value, not just the technical expertise, the accountability, the person who knows your plan, knows your patterns, and isn't going to let you sabotage yourself without at least naming it. Data, systems, conversations, and support. That's what changes financial behavior. That's the formula.